Hello and welcome to another episode of Investing with IBD podcast. It's Justin Nielsen, your host, and it's May 17th, 2023. And on the show, we have Arusha Peiris, a portfolio manager from O'Neill Global Advisors, joining us as he does every week. How are you doing, Arusha?
I'm doing well, Justin.
Excellent, excellent. And fresh off the big CMT event that was just recently celebrating a big anniversary, we have David Lundgren joining the show. Now, David is a portfolio manager over at MOTR Capital, and he is also for the CMT Association. He does a podcast called Fill the Gap. So it's great to have David here. He's going to be talking about some of the things that he's learned over the years. Of course, he is a CMT like Arusha. And how are you doing there, David?
I'm doing excellent, Justin. Thanks for having me on the podcast. Great to see you, Arusha. This
Yeah,
is
great to
it's
see
been
you.
an honor. This is an honor for me to be here. I've been a follower of William O'Neill's work. I used to get the Daily Graphs books way back when, and
Okay.
I've been a follower ever since. I think I've read that How to Make Money in Stocks 10 times. My younger son has it, and he's got it all dog-eared and everything else now. So he's probably read it 10 times already as well. So his influence
Awesome.
continues to this day.
What was the color of the first one that you read?
Oh boy.
Because now we have the white, the red, the blue,
Yeah.
and the orange and the green. So
I think it was the white one.
okay, so yeah, that's the oldest.
That's the
That's the
first
first
one,
yeah.
edition.
Yeah.
The second edition was the red, and then yeah, I helped out with the blue, the third edition, and the fourth edition.
Yeah.
So yeah, good stuff. I mean, certainly, so much knowledge, just packed into those books, and of course the charts, especially the fourth edition with the orange.
Yep.
The orange cover, it just has those 100 charts at the beginning that just kind of gives you a sense of, hey, here's how America got built with all these stocks. But we'll certainly get into some of the learning lessons there. We'll cover the market today, also some of the ideas behind patience, process, and not firing until you see the whites in their eyes. So, and of course, then we'll also talk about some individual stocks. But let's go ahead and start with the market. Very strong day today on Wednesday, and a little bit of breadth too, which was nice to see, since that's been one of the issues. David, where would you like to start? Do you want to start with the NASDAQ composite, or?
Yeah, I mean, we can start with the index that's lying the most. So yeah, let's do that.
Okay, perfect. Yeah, so the NASDAQ composite, of course, again, here we are at highs for 2023, climbing back after a bear market in 2022, and all the moving averages are kind of in line, and we're above those. So what could go wrong here?
Well, I mean, if this is all you were looking at, then you should absolutely be long with the idea that we're about to start a new cyclical bull market. And I'm not saying we're not. There's just a lot of things that you don't see that are going on beneath the surface that you don't see by just looking at the NASDAQ 100. But when you equally weight the performance of the tech sector, it's actually, out of the 11 sectors, it's the sixth best sector. So this is the best index without question. But in terms of sectors equally weighted, so you strip out the cap bias, it's only the sixth best sector. So there's a lot of disconnect going on beneath the surface, and it just comes down to, it's not to say that this can't continue higher. It's just to say that if it does continue higher, just be mindful that the generals are marching up the hill and the troops are still back at the camp drinking coffee.
not the usual case. Yeah. So again, it's one of those things where you might be finding a disconnect with your portfolio, because if you're not in the right stocks, you're not getting this type of action.
That's right.
Yeah. So David, what is, if this is number 6, what is number 1 on?
So yeah, I mean, that's actually part of the good news is there's a, the way I've been phrasing it lately is that there's just too many good things to happen. I mean, there's too many good things happening to not have long exposure. There's also too many bad things happening to not have short exposure. So you really should have both on. And I think if you look at the market, I mean, we've been kind of oscillating around 39.50 since May of last year. So we've been in a range for a year. We've been in a bear market internally for 2 years. But the point is, we've been in a range for a year. So that means that there's a lot of good things happening. There's a lot of bad things. So one of the good things that I can point to is that everything that I do is equally weighted, because I really strongly believe that, like, the phrase I use is lies, damn lies, and market cap weighting. And it's statistics, right? It's just what market cap weighting does to your perception of what's happening. So if you equally weight the various, like the technical structure of the various industries, the number one industry is industrials. Number two is consumer discretionary, and it's been number two for a long time, despite the fact that Amazon, for the longest time, has been holding down the discretionary sector. It's actually been the number two sector for a long time. Number three, unfortunately, is staples. You don't want to see that.
Right.
And then after that, we have materials, healthcare, and then tech.
Mm-hmm.
That's really interesting, especially
as you said, not even the top five. And when you have defensive areas, really kind of taking some of those top spots, that's something that we're not normally looking at as growth investors to be the leading.
And I hate to even get further into the weeds on this, but you can also look at, it's kind of like looking at beta, but there's problems with beta. One of which is that it's a 5-year look back and beta changes, so it's kind of too slow to respond. So I measure performance of stocks in different ways, almost like upside downside capture. And when you do that and you rank every stock for its upside and downside capture, what you find is that a lot of the stocks that are leading in industrials actually are a bit more defensive. So it's on the one hand, it's good to see industrials as a leadership sector, but it's certainly not like staples, and it's certainly not utilities. But having said that, even still within industrials, there's still a lot of defensive leadership going on there.
Mm-hmm. And it's worth mentioning that your fund is a long and short fund,
right.
So you do both.
Yes.
So maybe talk a little bit more about that idea that you brought up from the beginning, is that you kind of have to have both in this market.
Yeah, I mean, it's funny that I'm definitely a bullish person by nature. I can't wait for the next bull market. I'm kind of chomping at the bit because I love it, like everybody, all of your listeners do, I'm sure. But there are times when you need to be able to recognize that you're just not in that environment. And I would say even there, in all instances where trend following is not necessarily really rewarding you, even then it may not be the right decision to short things. Mm-hmm. But sometimes you're actually in such an environment that you should get short. And I think the past year has been one of those environments. And so I think everything I do is systematic. And so I'm just trying not to overlay or enforce my opinion on the market. And so when you do that, and you just kind of like take a look at the market from a higher level systematically, and from the bottom up systematically, there's just way too many charts that are just starting to break tops even still. So a lot of the financials are broken down already. A lot of the banks are broken already, but there's a lot of charts that are, for every chart that looks good, I can show you 1.5 to 2 charts that look bad.
Yeah, that's true. Now, so David, what would you need to see to kind of get you more bullish using kind of the sector view that you're using, the equal weighted sector view?
So I have this I guess it's called an indicator, but it's called a risk gauge. And what it does is, like, there's 5 things I care about. Everything else I monitor because I'm interested. Sometimes it can be useful, but most things I don't care about. Like, I don't care how steep the yield curve is. I don't care what the Fed just said. I don't care about earnings season. I don't even care about what sentiment is, because I have this sort of philosophy that I try to rely on. That I refer to as the inviolable rules of trend following. Mm-hmm. And so everything I do is based on these inviolable rules of trend following. So, C cannot happen. If we're at A and you're thinking C is going to happen, C can't happen until B happens first. So everything I do is based on those concepts. So, like, if you're looking at a stock and it's at 10 and you think you can go to 50, I can guarantee you there are no guarantees in this business except for this one. That stock cannot go to 50 unless it goes past 11 first.
Right.
That's trend following. That's the essence of trend following. So my entire research process is based on concepts like that, around 5 different concepts. So it's price trend.
Okay.
It's relative price trend. It's the fancy word is cross-sectional momentum, which is what technicians have been calling momentum, since the 1930s. So it's just traditional, ranking stocks and comparing them to each other. So momentum, and then breadth, and then volatility. Those 5 things have certain profiles in every bull market and in every bear market. Whereas, like, last year is a good example of why sentiment, although I follow it, sentiment's not in this model, because last year we had in many instances, in many gauges, we had record bearish readings, and the market just kept going down anyway.
Right.
Mm-hmm. So like, just because the market is, everybody's really bearish, doesn't mean the market's going to go up. So you can't rely on it from like an inviolable rules of trend following perspective. So when I do that, and I do it across 4 time frames, you go all the way out to the quarterly chart, which to me is like, that's kind of where I live. That's the trend I'm trying to capture.
Wow. Okay.
When you do that, you think about the reason I do that is because, and this is very much because of, my influence, the influence from William O'Neill is just to really focus on those fundamentals. Because, I often say that if somebody asks me what's more important, fundamentals or price trend, I wouldn't even hesitate 2 seconds to say fundamentals, because without strong fundamentals, there are no strong price trends. It's just that there's a huge distinction between fundamentals and fundamental opinions.
Right.
When you look at performance of actively managed funds over the years, I think it's 89% have underperformed. And the reason they've underperformed is because they're trying to exert their opinion upon the market. And this is like with rocket scientists on their team, like long-term capital management and all these other things where CFAs.
Well, they have even more educated opinions.
Yeah, I get insulted if somebody ever tries to call me. Not that this has ever happened, and I don't think it ever will. But if anybody ever called me the smartest person in the room, I'd be insulted.
That's the kiss of death right there.
But the idea is, if you look back in time, in any 1 year window of time, the biggest influence, well, let's say half of what happens to a stock in a given year is driven by valuation expansion and contraction. So if you ask me what's the best sentiment gauge that you could possibly look at, it's valuation. In 1 year, people are willing to pay 20 times earnings, and then they're willing to pay 50 times earnings. That's sentiment. That's confidence. It's how much optimism you have. So in the short term, it makes sense that in the short term, valuation expansion and contraction drives half of what happens to a stock in any given year. But when you start getting out to 3, 5, 10, 15 years, the expansion and contraction of valuation drops to, I think it's 5%. And then 95% of what makes a stock do what it does over that 15-year window is fundamentals. Right. 75% of it, this will probably make William O'Neill smile, or Bill smile, is 75% of it is top line revenue growth. Right. So all of that is to say, that's why I believe fundamentals are pretty much all that matter. That's what the evidence shows. But it's not my fundamental opinion that matters. It's the market's opinion of the fundamentals that matter, which is a long way to kind of get around to your original question, Arusha. It was so long ago, I think it was Arusha that asked it. It might have been. but this is why I focus on that quarterly chart, because ultimately that's the one that's driven by fundamentals. When you start going from quarterly all the way down to daily, this is not an original concept. This is what Charles Dow said over 100 years ago, that the shorter the time frame you look at, the more you get into the field of emotions and emotional responses to fundamentals. You get out to the monthly and quarterly chart, it's about fundamentals. So when you do this analysis, that 5 timeframes, the 5 inputs that I told you about over 4 timeframes, when you do that on the quarterly timeframe, almost 60% of the market's in a downtrend. And the quarterly chart's driven by fundamentals. So that's the problem that I see here. So you asked me what do I need to see change? I need to see that. I don't need to see that get really, really bullish before I get bullish. I need to see it inflect positive.
Okay, but getting over 50% or
it doesn't necessarily have to inflect above 50%. It just because remember this concept of trend following, and trend is fractal, meaning that the quarterly chart cannot possibly, this is another inviolable rule of trend following, which is why I do 4 timeframes. The quarterly chart cannot possibly get better unless the monthly gets better first, which cannot get better unless the weekly gets better first, and then on down to the daily. So most people, if you ask them what's the long-term chart, they'll I think very fairly say, the weekly and the monthly chart are what I consider long-term. And I think that's fine. I have no problem with that. I happen to follow quarterly, but weekly and monthly get you there as well. But the point is if we get strong enough inflection on the weekly and monthly timeframes, and those trends inflect enough, then I'm willing to bet that the quarterly the quarterly timeframe risk gauge is going to inflect as well. And if it doesn't, it doesn't. But at least I have structure to manage my risk on those positive inflections that happen on the weekly and monthly timeframe.
Yeah.
So it's not that you need to wait for everything to get rosy before you get bullish.
Right.
In fact, this analysis, the reason I do it from the bottom up is because it does tend to get better. You guys know this as well as anybody, that breadth precedes price in terms of market turns. So this is all based on breadth. So this will inflect before the market inflects.
Yep.
And
it's
so
kind of like
I
the follow
to inflect first.
I mean,
Yeah,
it's
yeah,
kind of
yeah,
like the
exactly.
today.
Like
You'll
follow the
have some groups working. Not everything's working, but you're seeing kind of that breadth start to increase, more breakouts coming, and getting more reasons to get pulled into the market.
Exactly.
Yeah.
You know, one of the things that I want to stress as well is I really try to avoid, timing the market, like being bullish and bearish and changing my exposures based on that. I try to be as systematic about it as possible. But even in environments like this, where I have very low gross exposure, because that's the kind of environment we're in, I have longs, I have shorts. It nets out to about 20% net long.
Okay.
But the way I gross down the long side of the book is I don't take on fewer positions. I still have, in a very strong bull market, I'll probably have 35 to 45 names on. Today, even though I have roughly 40% long exposure, I still have 40 names on.
Okay.
So when the market inflects positive, all I need to do is cover my shorts if I haven't already, and then just gross up my long book, and I'm already long when I want to be long for the next bull market, as opposed to, okay, we just inflected, now what do I buy?
Right.
So I'm constantly, constantly upgrading the long side of the book, so that when the market does inflect, and it absolutely will inflect positive eventually, I'm already long when I want to be long. I just need to gross it up.
Right. And I guess that's been one of the frustrating things about this market is that we've had a few of what looked like we were starting to trend on the short term, but it just hasn't lasted. I mean, even in 2022, sure, you could point to some really strong rallies that lasted up until the 200-day moving average line, got turned away right there. And again, it was kind of that lasting component of it that we just didn't have. And that's probably been one of the more frustrating things of 2023 is I feel like that time frame has gotten even shorter.
So David, for the 40 stocks that you'll have, those are they're mainly screened by fundamentals, right? And or is it?
They're not, but so the names that I have right now, I'm almost positive that if and when the market does inflect, not all of them are going to survive, because they'll get pushed down by other things doing better.
Yeah,
but the point is that they're all horses at the right starting gate. And when the race starts, obviously, this is what's great about trend following versus I guess the way I'd say it is that trend following is a lot like betting at the horse track, except with the exception that you can actually wait for the race to get started and figure out who's winning, and then place your bets.
Yeah.
And then you can also even change
your bets. Yeah, I was going to say changing your bets is even the best part, right?
I like that a lot. That's really good.
I always think of changing your bet as being the best
you can
part.
actually change horses midstream.
Yeah, right, exactly.
That's great.
Yeah. So just real quickly before we kind of wrap up this section, you mentioned that volatility was one of the components that you were looking at. What kind of aspect are you using there? Are you looking at an overall volatility measure like the VIX, or is that something more specific to the individual stock like the ATR, or what is it that you're looking at there?
Yeah, it's the average true range, but I break it down into good volatility and bad volatility. So good volatility is obviously if you're long and it goes up a lot. A lot of volatility products will ding you if you go up a lot, right? Which is a problem. So I break it down into good volatility and bad volatility, and then I also measure if the volatility is going up, increasing or decreasing, and then I also measure if it's above average versus below average. So you have these sort of like three metrics. So ideally, what you're looking for below average volume that's falling, and it's good volatility, right? So I do that for every stock in the 2,500 stock universe that I monitor. Wow. And right now, I mean, it's the biggest bucket is, let's see here. Yeah, so 78% of the volatility is below average, 88% is falling, and 41% is good, meaning 59% is bad volatility, meaning that more volatility is being experienced on the downside than on the upside.
Yeah, that makes sense. I mean,
so one of the things I was going to say about last year that I thought was interesting was, remember I talked about those risk gauges. I measure them in 4 time frames: daily, weekly, monthly, and quarterly. Right. And so during the bear market, the weekly and monthly time frames were down and risk off. meaning we're in a full on bear market
Right.
in the weekly, monthly timeframes, which remember is most people's long-term chart. These are still fundamentally driven. So we're in risk off. And so as we had those big 12, 18% rallies in 2022, the daily time frame of that gauge went all the way to risk on, as you can imagine it would, and went right to the 200-day average. And despite getting that magnitude of rally, the weekly and monthly time frame stayed in risk off.
Yeah, I can see that. Yeah, go.
Right.
I mean, you can almost you'll use like the 200-day moving average, right?
Exactly.
Right? Yeah.
But the difference
like
is that
yeah.
the rally from October to November and then through December, a lot of things happened on that rally that was very, very different from what happened during the big rallies prior to that. The most important one, I think, was the momentum crash, which is it's a bit of a rabbit hole of a conversation, but it essentially means that if you think about factors, whenever you hear somebody say the phrase factor, just think about a hedge fund, and the factor or the hedge fund is long the best of something, and it's always short the worst of something, always, regardless of what's happening in the market. So in the case of momentum, it's long what's outperforming, and it's short what's underperforming. And during bear markets, the momentum factor, i.e. hedge fund, actually does really well, because what's doing bad is doing really bad, and it's doing so in a very volatile fashion, and you actually mint money on the short side as a momentum investor. In the long side, probably, and if it's a bad enough bear market, it's probably going down as well. It's just going down a lot less.
Right.
So it's working out great. Everything's great until the day the market bottoms.
Yes.
And the nature of the way bear markets bottom is it's like quick. The momentum has a 12-month look back, so it's still thinking that everything that's down 70-80% is still the worst stock in the market. But they can go up 30-40% and still be in the bottom decile of momentum looking back a year. So you end up with this momentum crash. Those momentum crashes happen when it's like whenever you hear the phrase, or if you hear somebody talking about momentum crashing, that's very bullish for the market. It probably means the market bottomed, but it's really bearish for the momentum factor. And we've experienced that now for a year, because the market momentum factor has been kind of like all over the place, and trend following has been all over the place. That's because the market's trying to figure out where the leadership is, but it'll figure it out. And we just need to be patient and keep our bullets, keep our ammunition dry, and just kind of wait until we see the whites of their eyes, if you will.
Okay. And to that end, on our next segment, we're going to go ahead and talk a little bit more about this whole process, and also why it pays to be patient, and when is the right time to be trading, what kind of thinking you have to have. So stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, along with Arusha Paris, who joins me every week. He's one of the portfolio managers over at O'Neill Global Advisors. And on the show this week, we've got David Lundgren. He is a CMT. He is a podcast host of the Fill the Gap podcast from the CMT Association, and also a portfolio manager at MOTR Capital. So, David, you threw a lot of different things for us to look at, but maybe it's time to kind of see some visuals of exactly what you're talking about, and of those components that you look at, your main rules. Let's talk a little bit about the breadth, and maybe we can show a visual of that for the folks that are watching this on video, and that's always available at investors.com/podcast. So tell me what we're seeing here.
Yeah, so on the left we have the S&P 500, and you can see the green box and the red box. These are the ranges that are pretty much, they define trend, and you really can't get too bearish unless you get below the green box, or too bullish unless you get above the red box. And so even the Nasdaq's not above its own red box. It's not featured here, but it's still below there. And the picture on the right is the value line geometric average, and that's an equally weighted index that has about I guess it's about 1,500 stocks in it. And what you can see is during the decline from last year, they pretty much moved in lockstep with each other, right up until the moment the banking crisis actually started. So the banking crisis started on March 7th. So if we measure everything from March 6th, we can see that both the value line average and the S&P went down into the green box as a result of the banking crisis. But if all you're looking at is the S&P 500, you can now see that we're now back to overbought, and it looks like not only are we overbought, but we're actually above where we were the day before Silicon Valley went bust. So it looks like we dodged the banking crisis bullet, which would be, if you're looking at this alone, that would be a fair assessment. But if you look at the value line average, which is, again, equally weighted in telling you what the average stock is doing, we're still oversold. We're nowhere near above where we were before the banking crisis started. And actually, if you look at what's actually happened since the 6th of March, there's only 3 sectors that are up on average. And I think I could probably win a bet in a bar if I ask this question, but unfortunately, the 3 sectors are utilities, healthcare, and staples.
Yep.
Everything else, and I stress everything else, including tech, the average tech stock is below its March 6th low. And what's even worse is if you look at the market there, the S&P, it bottomed on March 13th. Since the market bottomed on March 13th and ran all the way across the range, it got back to overbought. Since that bottom, the average bank stock has dropped an additional 15%.
Wow.
So that's what's going on beneath the surface. And it's critical to realize that none of this means that what's working won't continue to work. I mean, we saw from 1998 to 2000, that was that stealth bull market. That was the old economy versus new economy. Maybe the bull market going forward will be all driven by AI related stocks. It's possible. You have to keep an open mind. But what it is saying is that in this environment, it's not just the opportunity set's not just long. There's still shorts to be had. And unfortunately there's a lot of them. And as I said, the average tech stock is down about almost 6% since March 6th.
Yeah. And I feel like in a normal environment, you kind of have these more in line with each other. This divergence is not the norm. I mean, certainly, ideally, when things are going up, it's kind of like everything's going up, and it's a lot more forgiving because yeah, I'm doing good, but everything's doing good. It's kind of like you don't have to be a genius to pick a stock. Darts do a pretty good job, but in this market, I mean, I guess it's that classic line of stock pickers market, because if you're not in the right stocks, you're not having a good time.
Yeah, there's it's always a stock pickers market. Even in a bull market, it's still a stock pickers market, because that's actually, to me, if you ask me, if the S&P continues higher, driven by a handful of stocks, and everything stays down, everything else stays lower, that's a pretty easy market because you know exactly what to buy. I mean, it's like buy these 20 stocks. But if we actually go into a robust bull market, that's actually harder.
I mean, you're almost a kid in a candy store at that point, right? Because you're
exactly.
You're like everything's going up, and like, how to figure out? That doesn't make a lot of sense. I mean, it's almost it's funny because it almost seems like both. It just depends. Like if you are in these AI stocks, you have every right to be bullish, right? Even though it's a narrow type of market. But if you're bearish because you see all these other stocks collapsing, it's like it's an environment where you can have both parties right. It doesn't have to be either or in this case.
Yeah, it's actually the quote on this page from my website says this condition reminds me of F. Scott Fitzgerald's quote: "The test of the first-rate intelligence is the ability to hold 2 opposed ideas in the mind at the same time and still retain the ability to function." Right? That's what this is all about. And so you can puzzle about it, you can be confused about it. And that's all fine. And I'm not saying that that's a bad thing. But at the end of the day, if you actually just kind of step back, what it's actually saying is, if this is trend following, well, we follow trends. Well, where are the trends? Well, they happen to be in both directions. Well, what should you do? Well, you should do both. It's a hedge fund after all. But I will say this too, though, that the rally that happened off the October bottom was, as I said earlier, was distinctly different, importantly different from what happened during all the other rallies during 2022, indicating that whatever the market was concerned about during 2022, the lows in October fully discounted it, and the market was looking forward and it liked what it saw. So with that being a backdrop, in the fact that the market was down about 25%, whenever the market's down 25%, you do one of two things from there. You either bottom, base out, and then go into your next cyclical bull market, or you go down another 20% in a crisis mode. So what we've had so far up till now has been a cyclical bear market. I wouldn't deem this as being a crisis bear market like 2008, 2009, that kind of thing. So whenever we get this far down in the market, I'm always looking for short ideas, but I'm also mindful of the idea that we're probably close to done.
Right.
And the fact that we had the magnitude and quality of rally that we had last year off the lows tells me that the market was looking forward and it likes what it sees. Since then, of course, we've had this banking crisis, and as you can see, both indices are holding above support, despite the fact, think about this, despite the fact that the 3 of the 4 largest bank failures in U.S. history have happened in the last couple months, and we're still above support. You can't ignore that, right? So put all that together, and what do I think? I think we're probably going to bottom. I think my risk gauges are probably going to inflect higher, and I'm probably going to cover all my shorts, and I'm just probably going to gross up my long book. But I'm not really in the forecasting business. I'm in the reacting business, and right now I don't have anything to react to from what I currently have on.
Let's talk about this a little bit more in terms of this forward-looking kind of idea that the market does, and this is kind of the whole concept behind trend following, is that we want to be on the right side of that, and sometimes it does require patience, because just because you bottomed, as you said, doesn't mean you're going up immediately. You could be basing out, and we've seen that a number of times. The bottom, there's the V-shaped bottoms, which they act one way, but then there's the bottoms that happen and you kind of drag on for a little bit before you really start going. So maybe you could talk a little bit about the mindset that you have to have in order to remain patient during those times.
Yeah, I think this is a critical concept. And when at our last CMT symposium, I had the great opportunity and fortune to interview Jerry Parker, who's one of the few turtle traders who came out of that whole experiment, with a great track record. And the whole point was that I could have had him on the stage in front of a bunch of CMTs, 350 technically minded investors, and asked him questions about his process, and does he buy the 200-day breakout or the 213-day breakout, just to try to get the edge on what he does. But the truth of the matter is that none of that, it's like you can't make money unless the process works. But just because you have a good process doesn't mean you're going to be able to make money. And his experience is case in point. He was, back in the early 80s, he was one of 20 turtles. They were all taught the same exact breakout system, risk management. They all traded the same instruments. They traded in the same office. And they were all taught by the same exact legend of trend following. So if there ever was a situation where you were going to have a tailwind to start your career in trend following, go on over the next 40 years and crush it, that was it. But how come nobody asks, well, if that's true, then why did only 3 or so turtles actually do really well? I mean, if it's just signal and if it's just risk management, it's not just that. It's mindset. And when you talk to Jerry Parker, it's his mindset is what kind of carries him through these difficult times. And we're in one right now. And you hear a lot of people today talking about how, quote unquote, trend following is not working. And I think that's just half right. That, what is trend following? Trend following is a process that gets you on the right side of major trends and does really well in that environment. But it also does a great job of identifying bad environments and protecting your capital. So is trend following not working over the past year? I'd say it's working great. It's doing a great job doing the other half of what you signed up for, which is protecting capital. So the idea is, dig small holes when you're just in an environment that's not, ripe for, right tail events. But always, as I said earlier, even though we're in a bear market, I'm always upgrading the portfolio and making sure that I'm owning those horses that look like they're most eager to get this race started. And then when the bull market starts, which I'll be able to identify with the inflection in these risk gauges, I'll just gross up my book. But until then, I have in my mindset, as I said earlier, these inviolable rules of trend following. If I'm anxious about wanting to buy a stock, like Riot is a stock that looks like it's trying to come back again. There's a whole bunch of other ones that look like they're trying to come back again. If I'm anxious about trying to buy a stock like that, and I think it can go to 50, but it's at 10, it can't possibly go to 50 unless it goes above 11. So let's just find those levels that matter. And below there, don't be anxious. Just let trend following do what it does. Protect your capital until it's time to, put your capital at risk. And that's all mindset. It's be patient and just let the process work.
Yeah, I mean, it sounds like you're truly listening to the market, right?
Yes.
You're trying to keep that open mind and waiting and not predicting. which is, I mean, and it makes a lot of sense that when Jerry Parker, when you interviewed him, that only 3 of the 20 were able to make big money, because human nature messes everyone up, and from following that plan, right?
Yeah, I mean, the
Well, and I
market
think
has
it's
a funny
so.
way of taking down even the best and brightest. I mean, look at long-term capital management, everything else. So, if active managers, it's about 89% of active managers underperform doing fundamental analysis. And we can go back in history and isolate many fundamental analysts and portfolio managers who have done great. So is it the fact that nobody does well? Is it because of the process, or is it something else? I'd say it's probably something else, and it's the baggage we bring to the table as investors that kind of gets in our way of executing a process that works.
Well, let's use this example that you just kind of came up with. So you've got a stock, and it doesn't have to be Riot. It could be XYZ stock, the favorite stock of everyone. You think it's going to 50. Your indicators are kind of showing that, the trend and everything. But that there's this critical level. So do you think that it's that people are, it's a $10 stock, and you should be waiting until it gets to 11? Is it that too many people are buying it at 10 and not waiting, or are they maybe misidentifying where they should be buying it? What do you think is the biggest problem?
I think it starts with expectations. I think that people, when they buy a stock, they expect it to work. And that is so opposite of the truth of trend following. Over a full cycle, you're really, really good at this if half of your trades make money. And if you're in a bear market, you're probably doing really well if 30% make money, right? And you're doing even better in a bull market, 80%, 90% make money. You think you're a genius, right? The reality is, like, I have a statistic here in front of me that again, if you take trend and you break it into 10 buckets, 5 to -5, 5 is a high momentum uptrend, and -5 is a high momentum downtrend. And then you can say, okay, well, if measuring from when each of these trends started, are they in the money or are they losing money, right? So if you're in a bull market, all those positive, it's basically 1 through 5, all those buckets will be in the money. They'll be up from the moment they inflected to positive trend. And if you're in a bull market, anything that's in a downtrend is probably going to be up as well. That's telling you that whatever's breaking down is not going down, right? That's the proverbial bear trap, et cetera. But if you look at the numbers today, first of all, 50% roughly on the weekly chart, 50% of the market's in a downtrend. So again, that's pretty much, let's not ignore that. But when you look at all of the uptrends across, the 1 through 5, 56% of them are in the money. 44% of those breakouts have failed. Right? Then when you do the same analysis on the downside, -1 through -5, 94% of the stocks that are in a downtrend have gone down since they broke the level to put them in a downtrend. Wow, that's a bear market.
Yeah.
So knowing all this, that helps you manage your expectations. So like today was a big up day. I didn't have a great day today, but I had a bunch of these really bad days in 2022. But I stuck to my guns, and when the market got overbought, the models didn't inflect. I just increased my short exposure. And so we're, right now it's, if you do this analysis on the quarterly chart, as I said, it's almost 60% of the market on the quarterly chart is in a downtrend. So if you get overbought in that context, that's an overbought long-term fundamentally driven downtrend. So that helps me build my expectations and put into context what happens day to day. So we were talking earlier about monitoring what happens with various buckets of trend. And if I look today, like the average quarterly time frame uptrend was up about 1% today. The average stock was up 190 bips today. So I can look at that and say, well, my longs weren't up anywhere near 190 bips today. So I had a terrible day. Something's wrong with my process, right? Expectations and mindset. But if I actually look and I see, all uptrends underperform today.
Yeah.
And the downtrends were up anywhere from 200 to 250 bips today. Downtrend stuff we don't buy.
Right.
We're not even trying to buy that stuff, right? So if I know that all the gains came today from stuff in a downtrend, am I actually going to start thinking that trend following is not working, or am I actually going to say, well, this is a downtrend? Volatility, by the way, is greatest when you're in a downtrend.
Yeah.
So it's all about perspective and really understanding truly deeply what you're doing and what it's going to get you to do, what has to happen in order to get you to do something different. And that's all based on these inviolable rules of trend following. And until they happen, you just have to keep perspective and keep the faith in that long-term process, if you will.
No, well, and there's a patience level. I mean, and you kind of made the reference earlier to the what we call the Bunker Hill strategy of not shooting until you see the whites in their eyes. And I mean, we were kind of talking about this as you were, discussing it and bringing it up. How scary must that be if you've got this whole host of things coming at you, which we do. I mean, we've had over the last year all sorts of news coming at us. Right now, it just so happens to be the debt ceiling, but there's certainly recession, inflation, all of these things. And you're supposed to be, just sitting there waiting, and not firing, quite yet. So I guess, what do you rely on in order to give you that conviction of, hey, waiting is going to be the best thing for me? The
process. Like I always remind myself that what I'm doing is based on these inviolable rules of trend following. Like, good things can't happen unless these things inflect. 10 can't go to 50 unless you get above 11. It's like that across five measurements on 4 time frames. So good things can't happen until these things inflect. But when you think about that wait, don't fire until you see the whites of their eyes, you can imagine the anxiety and the fear they must have felt. Putting to shame any anxiety or fear we feel today, FOMO or whatever, as a trend follower. But, so you ask yourself, like, what was it that probably gave them the courage to do that? They have a loaded gun. Hopefully it works. This was back in the Revolutionary War. So it's a loaded gun, but they had very little ammunition, and they're waiting until they can literally see the whites of their eyes before they fire. What gave them the confidence to do that? I would say it had to be some combination of their respect for and confidence in Colonel Prescott, the guy that told them to hold their fire, and just a confidence in his long-term strategy of how, the reason he's doing this is because we don't have a lot of bullets. We have to wait for them to come upon us. So they just believed in what they were doing, and they understood it, right? Same thing here. You have to have respect for the message of the market. I always say the market is the best fundamental analyst on the planet. That's why it's so hard to beat. So just listen to the market, right? Have a structured way to listen to the market, which is the process I'm describing, and then just have confidence that over time, trend following works. It doesn't just work. It's the best strategy over time. And I would actually tell you that anybody that's done well over time is either explicitly tells you they're a trend follower, or they're implicitly a trend follower, because nobody makes money unless the price goes up. So it's all trend, right? So you just got to have belief that trend's going to come back again, but you'd have to have a structured way of identifying when it does come back, and then until then, hold your fire.
And David, and really, I think to end this segment, just maybe a couple of quick comments on value stocks and how that strategy is in your opinion.
So this is a bit of a controversial statement, but I strongly believe that value doesn't work. And by that, I mean is that stocks don't go up just because they're cheap, right? So you can look at this chart here, and you can see that since the bear market started, value, this is just a ratio between value and growth. So value in the numerator, growth in the denominator. So when this line is going up, value is outperforming. And we all know this. Value has been outperforming since 2022, the beginning of the bear market, basically. And so we can look at this and say, undeniably, at least the way it's measured here, which is a whole other conversation, value's been outperforming. But what I always say is that value doesn't work. Like, stocks don't go up just because they're cheap. They need a growth catalyst to unlock that value opportunity. If there is no growth catalyst, then they just become value traps. And the opposite can be said of growth names too. Like William O'Neill has always said that valuation is not a good way to pick growth stocks, because growth stocks can keep going up even though they're quote unquote expensive. The reason they stop going up is not because they're expensive. They stop going up because the fundamentals inflect negative, right? So that's always what makes growth stocks go down and value stocks go up. So if you actually scroll down on this, Justin, on this page, what I did with this exercise here is I looked over the past year, this year in which value outperformed, and I just took the 1 year growth in revenues and I plotted that on the x-axis. And I took the 1 year change in price and I plotted that on the y-axis, and I created this scatter plot. And you can then create a best fit line, which is that red line. And if it's upward and sloping to the right, there's a positive correlation between top line revenue growth and price performance. So the top chart tells you that value is working, But I would say, as always, it's not value working. It's revenues are driving that inflection higher. And this shows that, revenues are always what matter.
Yeah.
Top line revenue growth, particularly over the long term, is what drives performance. And, as much as we can say value outperformed last year, it's still driven by revenue.
Mm-hmm. Yeah. Well, that's a good place to end this segment. When we come back, we're going to talk about some of the stocks that are on your radar. So stay tuned, everyone. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, along with Arusha Paris, and together we are chatting with David Lundgren, who is a portfolio manager over at MOTR Capital, also has his own podcast, Fill the Gap, which is something he does for the CMT Association. And, we just kind of learned a lot about his process, all of the things that he's looking at, and why he's not worried and actually kind of excited about the prospects going forward. So maybe you could start with a few stocks that are on your radar. And you mentioned already, you kind of teased Riot. So maybe we start there. What is it about Riot that is looking interesting to you?
Yeah, so I wanted to bring this one up for a couple of reasons. One, because if you again reflect back on that inviolable rules of trend following, this stock has checked those boxes. So if you look at just the last swing high, you've got this double base in place. So this is a trend reversal by most measures. Obviously, you have a lot of overhead resistance still in the 20s, the mid 20s, but the volume has been, as if you go to the daily chart, you don't need to, but if you went to the daily chart, you'd see a nice pullback in the volume during this base. That looks like a nice flag pattern. So this, by all measures, is a stock that should be considered on the long side. But one of the things I want to bring up about this is that there's a tendency to lean back on the prior bull market's leadership and expecting it to lead in the current bull market. And the truth is, and I think might have been Arusha might have said that the work you've done says it's only 12% of stocks that led in the prior bull market lead in the next bull market. So we need to be mindful of that, right? So we don't need to forecast that. This stock has checked all the boxes that we need to check in that inviolable rules of trend following process. It's got a 98 relative strength rating. You can see the revenues have dropped off quite a bit, so that's not a positive here for sure. But having said that, the point is you don't need to forecast whether or not this will be leadership for the next 10 years. You don't need to even think like that ever on any stock. What you need to know is that this stock is in an uptrend as long as it holds above 8. That's what you need to know. And so with the stat that I gave earlier, where something like 54% of the stocks that have broken into an uptrend, only 54% of them are still above where they were when they broke out. Be mindful of that. So how do you translate that into portfolio? Well, you should always be executing and always be buying charts that look like this, no matter what. But when you're in an environment that's not conducive to follow through, which we can measure statistically, just make it smaller. Don't raise your stop. Don't make it tighter, because that's not trend following. Trend following, there's nothing wrong with a stock above 8. So don't put your stop at 10. That's not going to help you. Just position size it accordingly so that you have it positioned properly so that you can sit through a decline through 8 in what is not yet a bull market. So this is a good example of a stock that's broken the downtrend, all those inviolable rules of trend following. It ranks by most measures as an attractive stock, but it's the past bull market's leadership, and it was a doozy too. It was quite the bubble. This one fully participated. So don't be surprised, right? Expectations, mindset. Don't be surprised. Expect this stock to fail. Why? Because most stocks do fail. Most stocks are failing now, and then just go about your business. And if it fails, it's not going to destroy you.
Yeah, and I like that expect stocks to fail.
Yeah,
right. Because you do have a risk management in place, so you have a plan to get out. And it's not going to be 100% fail, right? You're not going to be 100% wrong. You might be wrong a lot, especially in a bear market, but chances are you're not going to be 100% long if you are looking for stocks and uptrends.
Right.
Now, on the fundamental side here, as you mentioned, look, the revenues have dropped off, but there is, part of the stock is the whole blockchain.
Yeah.
We've been seeing, Bitcoin and Ethereum, kind of improving lately. So, how much of the story here do you put into your analysis, since this is something that doesn't have revenues?
It doesn't, but I'm a student of the markets. I've studied the markets back 200 years, as far back as I can. So I love studying markets and cycles and what drove them and all the technology revolutions that drove cycle to cycle and things like that. So I'm a huge fan of it. It's just not in my inviolable rules of trend following, because
Hmm.
none of that has to happen again, right? So, having said that, how do I think about it? I'm mindful of the idea that what happened last year in 2021 in particular was comparable to what happened with the dot-com bubble, where
Hmm.
most stocks did not come out of that alive.
Hmm.
And so it's correct to believe that most of the stocks that went through this bear market that we just had will not come out alive. So that's
Hmm.
a proper expectation, but that doesn't mean don't buy them, because if you had that mindset, you wouldn't have bought Amazon when it turned, like you
Right.
see happening here, right? So it's not about forecasting or knowing or having this particular insight as to which one's going to make it versus not. It's about recognizing that this is structure that you can work with,
Hmm.
right?
Very good.
But Bitcoin is it looks fine to me. I think you can actually be long. I think that has structure that you can manage your risk with, and maybe go to 40,000 or 50,000. If that happens, this stock is going to do great. But one of the concepts we mentioned earlier was a momentum crash. And momentum crashes are all about things that were priced to go to zero in a bear market, doubling and tripling off the bottom because they're not going to zero. And many of them actually inflect trend and get you kind of to buy them. The problem being that the reason that they came off the bottom like that was because they weren't going out of business, not because they have a great 10 years ahead. So there's a risk of that being the case here. That that the stuff that lead off the bottom is usually the stuff that did the worst in the bear market. And it just because they did the best off the bottom does not mean that they're going to do the best in the oncoming bull market. So you always, as I said earlier, you need to constantly be upgrading the portfolio, making sure that you're in the right stocks, and just be mindful that this is a stock that could easily be one of those momentum crash participants, and don't be surprised if it fails.
Hmm. Okay. Well, you know what? Let's go ahead and shift our attention maybe over to chips, because the semiconductor industry is one that we are pretty confident we can rely on, being here for the long term. It's just a matter of who the players are going to be, who the main players are going to be, because that's shifting a lot of times. So let's take a look at Onto Innovation, ONTO. This is, this is looking very different from a lot of the other chip stocks.
Indeed, chips, generally speaking, if you want to just call up the SMH real quick, I mean, it looks like a bottom. It looks like it's like the turn is in, and you've kind of done a flag and you've retested it, and the 200-day average is rising. You've got that labeled as a cup and handle, which I think is I love that part of the service, by the way.
Yeah.
But that's the backdrop. That's sort of the bus that's carrying all the semiconductors, and some of them are up at the front of the bus, and others are at the back. And I think Onto is at the front if it's not the driver.
Mhm. And is there something about this particular structure that you're looking at? I mean, we've kind of crossed some areas of resistance here that it touched a number of times, but now we're clearly above that. So what about being extended? When something is kind of sticking up this far, do you then back away because it's come up already and you missed it, or what are your rules on that?
I do that. I have 4 setups. It's basically long 1, 2, 3, and 4. They're all great setups. They're just varying degrees of timeliness. So my preference is to buy long ones, which are stocks that it's very similar to what the way William O'Neill described it, and you guys to this day describe it, where you've just broken out of a base and you're not more than 10% removed from the point of breakout. Whether Onto is a long 1 or a long 2, which would be just recently broken out of a base, but you're up more than 10%. It looks like it's right on the border there. So I wouldn't qualify or characterize this as being extended necessarily, but I would say, remember that patterns that look just like this all year long have failed more often than not. So that doesn't mean don't do it, because you always have to execute the process. You can't just pick and choose when you're going to follow trend following. The way you deal with the fact that you're not sure, and when I say not sure, I don't mean like internally and you're nervous. I mean the data tells you to not be sure, because only 54% of the stocks that have broken out have actually made headway since they did that. So we're in that environment. So you should take a look at stocks like this, but size them appropriately for the possibility that it will fail. What I like about this one, though, is that there's very little overhead resistance. When stocks get into the new all-time high territory, there's, unlike Riot, which has all that resistance and people that may still own the stock, begging and pleading to get out even. Onto everybody that owns it is pretty much happy.
Yeah.
So for Onto here, were you using like an 89 as kind of the key resistance? So okay, now it's breaking above that. I mean, 89 kind of went through a number of bases there.
Right.
Okay. So you're using that, and then it's not super extended, but it is a little extended here. So you're going for a little bit smaller position. But I think one of the kind of the keys there that you're getting on, which is a really important concept, is you want to take those shots, take them smaller, because getting feedback from the market is the most important thing.
Exactly. And maybe we could talk about more specifically, like, what do I mean by make it smaller? So every position that I put on, and this is most trend followers do something very similar, is I have a specific value at risk that I'm willing to risk per trade. In a bull market, it's 50 basis points.
Okay.
In a bear market, it's 10 or 15 basis points, because there's 80% of what you do in a bear market on the long side is going to lose money. You know that. So why would you risk 50 basis points on every trade? So it's more like it's the same stop. You can't raise your stop, because that undermines trend following. Just risk less. So it just, by risking 15 basis points instead of 50 with the same stop, it forces you to keep a smaller position.
Yeah.
That's how I do it.
I like that. Yeah.
And especially, again, when you know that the odds are not in your favor, you're just okay. Yeah, this is what I'm going to do to adjust in my portfolio.
Yeah, but you can't look at this chart and not say and not buy it because you're concerned or you're worried or you're debt ceiling or whatever. You can't do that if you're going to be successful trend following. As I said, I own my full number of stocks that I want to own. I'm executing every single day. I also have a lot of cash and I also have a lot of shorts. But the idea is that when things inflect, I just need to gross up what I own.
Right.
How often do you rotate every single day out of that? So if you have like 40 stocks, how often will you adjust those 40 stocks?
So as you can imagine, it's environment dependent. So in an environment like this, my turnover actually is quite a bit higher.
Okay.
But when things start going, you can own stocks for 2 or 3 years.
Yeah.
Yeah, I was going to say that it does seem like we've suffered a little bit more from sector rotation, and it's like a constant, like where this is starting to look good, and as soon as it does, it rolls over, and the things that weren't looking good, the sectors start taking over, and then as soon as they start looking strong, so I mean, if you're using kind of like relative strength, it's just moving so quickly that by the time it gets strong enough to be on the relative strength leader, then it's done, kind of thing. So that's
the nature of trend following. You can't fix that. You can't change it. You have to accept it.
Yeah.
Expect it. So if you expect it and it happens, you're not freaking out about it. It happened and you expected it. So just move on.
Yeah. Well, you talked a little bit about this idea of the stocks that are kind of near their highs and don't have all this overhead resistance like Onto. Let's take a look at Casella Waste Systems, CWST. This is a stock that's already kind of at highs, and pollution control. It seemed like a lot of these pollution control stocks were appearing. Do you consider this a little bit more defensive, or is this a burgeoning area that we just need to be paying attention to?
Well, it's defensive in the sense that it does have this recurring revenue stream kind of aspect to it. It's garbage, right? So
right.
Especially if you're down in
Literally
Washington,
garbage.
A lot of garbage. But look at the revenue stream. I mean, this is a fast growing company. So it's a combination of recurring revenue streams to a certain extent, but also strong revenue growth. But this I wanted to talk about this one because this is an example of what I said earlier about how industrials have been the number one or number two sector throughout this entire bear market. Actually, the relative performance on the XLI actually bottomed, I think, on the day that the S&P peaked and started the bear market. So industrials
okay,
have been
that's
outperforming throughout this whole thing. And when we went into the October lows and everything went, aggressively to the downside, when that happened, the industrials actually broke a 5-year relative performance downtrend.
Wow.
So those are the things that, while you're in a bear market, it's not like there's nothing to do. These are the things you want to watch for. So throughout this whole thing, industrials and consumer discretionary have actually retained, with the exception of energy, which was up at the top for a long time. It's now down. I think it's number 9. And probably the reason it's not 10 or 11 is because it's fighting for the bottom of the bucket with financials and real estate, which is
right.
Yes, exactly.
a nice fight if I ever saw one. But this is a stable company. I think you guys have beta on this.
Yep.
Yes, beta is 74.74. So this is an example of a low beta industrial that's outperforming.
Yeah.
But it also happens to have a nice growth profile.
Yeah,
and it has
you can see it didn't fall that much.
So everybody that owns it's happy.
Right. Yeah, you can see it didn't fall that much, which was making it easier to get back to those highs. Because
Right.
I mean, this last base was, I think, only 18% or something like that, and it was
Right.
a little bit deeper before that, but certainly not the 70% plus of the Shopify's and Datadogs and so on.
Right.
You know what? Because you mentioned consumer discretionary kind of at the outset, I want to just add a bonus stock in here, and we'll see if our editor screams, and jumps on and says no more. But let's take a look at SHAK, just because, again, you mentioned the consumer discretionary. It seems like a lot of these restaurants, are looking interesting. I mean, CMG was one we were talking about on our show today. But what is it about SHAK that is kind of looking interesting to you?
It's another example of a company that has had a great growth profile, but it's gone nowhere for, I think it's 5 years.
Mm-hmm.
And so eventually what happens is that those fundamentals bubble up and they start to push the stock higher. And this, when you talk about post IPO patterns, this is kind of a nice looking pattern. And from a trend, inviolable rules of trend following, it's checked all the boxes. So whatever it needed to do to go to 200, it's checked those boxes. So now it's just manage your risk, chase it with your stop, manage your position size properly. But this stock has done everything it needs to do to be in an uptrend in this time frame, which is the time frame we're trying to capture this weekly chart.
Great. Well, hey, David, it was really a pleasure having you on the show. A lot of good things, statistics, process, and mindset for our listeners to think about. So really appreciate you sharing your thoughts.
My pleasure, guys. Thanks for having me on.
Okay. And that's going to wrap it up for us on this week's show. Next week, we're going to have another guest, of course, as we always do. Leif Serede is going to be on our show. And so we'll be chatting with him a little bit. He's a championship trader, and we'll kind of get into his mindset of what's working for him and how he's handling the current market environment. So hope you tune in for that. Thanks for watching this week. We'll see you next time.